All right, today we're pulling back the curtain on a secret weapon that pretty much every professional trader has in their toolkit. And it has way less to do with picking the next hot stock and a lot more to do with survival and long-term growth. So, what is the real difference between a professional trader and a gambler? I mean, really think about it. Is it some kind of sixth sense? A secret insider chat? Well, the answer might actually surprise you, and it's the key to this whole thing. Most people think the whole game is just about picking winners. But the reality, where the actual money is made and lost, it's all about how you size your bets. The biggest mistake you can make isn't picking the wrong thing. It's risking way too much or even too little when you place your bet. Now, for decades, the pros have been using this kind of mathematical secret to solve this exact problem. It's a framework that helps them tilt the odds in their favor, not just for one trade, but over the long haul. And today, we're going to break it down. Okay, let's get into it. This thing is called the Kelly Criterion. It was actually developed way back in 1956 at Bell Labs, of all places. And what it is a formula that tells you the mathematically optimal percentage of your money to risk on a single bet to get the fastest long-term growth. It's considered the gold standard. So here it is, the version that traders use. And hey, don't let the math scare you off. We're really just focused on the concept here. All you do is you take two numbers, your win rate and your average reward to risk ratio, you plug them in, and boom, the formula tells you exactly how much to bet. But here's the million-dollar question, right? Is something that's mathematically optimal on a spreadsheet actually a smart move in the real chaotic world? This is the trap, and it's a really dangerous one. You see, the raw, unedited formula, what we call full Kelly, makes some pretty wild assumptions. It assumes you know your exact advantage and that it'll never ever change. It assumes your estimates are always perfect. And get this, it assumes you're a robot who can emotionally handle just devastating losses without even blinking. And when I say devastating, I'm not kidding. Using the optimal full Kelly formula can, and often does, lead to portfolio drawdowns of 50 to 80%. Just imagine watching your account get cut in half, or worse. Even if the math says you'll eventually recover and grow, almost no human being can psychologically survive that. This is exactly why so many traders using the so-called optimal formula end up blowing up their accounts. So this brings us to the professional's real secret, something called fractional Kelly. Instead of betting that full, terrifying amount, they bet a fraction of it, maybe half or even a quarter. This is the simple tweak that puts survival first, which is the only way you get to stick around long enough for real-world growth. And this chart just illustrates the trade-off perfectly. Look at this. Using half Kelly cuts that soul-crushing volatility in half, but you still get to keep around 88% of the maximum possible growth. Think about that. You get almost all of the upside with a tiny fraction of the gut-wrenching risk. That right there is the professional's edge. Okay, so let's take all this theory and throw it into one of the most volatile arenas on the entire planet, crypto trading. This is where the rubber really meets the road. Let's use a scenario that many of you might find familiar. We're talking about sniping meme coins on Solana, a strategy that usually has a super low edge. It's high risk, high reward, and honestly, it's the perfect test for what we're talking about. First up, let's say you've crunched the numbers on your past trades, and you find out your win rate is about 28%. So you don't win all that often, but when you do, the payoff is good. On average, you have a 4-to-1 reward to risk ratio. So for every $1 you risk, you're looking to make 4. So you take those two numbers, you plug them into the Kelly formula, and it spits out an answer. It tells you the optimal bet size is 10% of your entire portfolio on a single trade. Mathematically, this is the fastest path to growth. But what does a professional trader do? They look at that 10% number and they do something completely different. In this exact scenario, they would actually risk somewhere between 0.5% and maybe 3%. Why? Because they know the variance is just insane. You could easily have 15 losing trades in a row. And if you're betting 10% a pop, you'll be wiped out before your mathematical edge ever has a chance to work. Hey, this isn't just about meme coins. Check out this table. It doesn't matter if it's high-frequency scalping, trading breakout altcoins, or making big macro bets. The pattern is always the same. The full Kelly calculation says to risk some huge, scary number. But what the pros actually put on the line is a much smaller, much smarter fraction of that. Their number one priority is always, always staying in the game. So how can you actually put this to work? It's a pretty simple 4-step process. First, you gotta gather data from at least 100 trades to get a good sample size. Second, you calculate your win rate and your reward to risk ratio. Third, plug them into the formula. And fourth, and this is the most important step, you risk a fraction of that result. 25 to 50% of it, absolute maximum. So let's just boil this all down into the core rules that professionals live by. Rule 1, never use full Kelly. Ever. Period. Rule 2, half Kelly is the sweet spot. It gives you growth and lets you sleep at night. Rule 3, if you don't have a solid data set of at least 100 trades, you don't really have an edge, you're just guessing. And finally, your edge isn't set in stone. Recalculate your Kelly size on a regular basis. Look, at the end of the day, the Kelly Criterion is not some kind of get-rich-quick scheme. It's the disciplined framework that explains how a trader with a tiny, consistent edge can compound a small account into life-changing money over time. And it's also the very reason why overbetting absolutely destroys almost everyone else. It's the line in the sand. The question is, which side of that line do you want to be on?
Please like and subscribe for more trading content, and then subscribe for more daily, weekly trading insights.